with bonds and equity sort of positively correlated. How do you hedge when, as you put it in your notes, there's a global tightening tsunami coming?
Yeah, so I think first, just very quickly on the Fed decision and why we sort of introduced this term of a global tsunami of tightening coming is that there was a period where we had global liquidity, fiscal easing, monetary easing occurring on a international basis. Now we have a situation where the opposite is occurring. And the concern that we keep on talking about internally in our investment teams is that, well, if that comes through, what will that do to demand destruction, and will it go beyond what the central banks are foreseeing today? I mean, Vincent was speaking about that earlier too. That will the Fed be balanced after the next hike? Will it move too aggressively, and will demand slow down much faster? In that environment, you continue to see heavy correlation occurring between equities and bonds. So in our portfolios, what we've been doing is restricting the directional bets, so making outright calls on equities versus bonds, but really thinking about two things. One is, how do we create diversification by doing more relative value trades across each of those markets? And then how do we start building up hedges in inflation-sensitive instruments, so whether that's real assets, commodities, and cash, which finally is giving you something. So the allocation to those, call it hedging, or instruments that give you some dry powder, has been increasing our portfolios from January through till now, and the actual directional bets on outright calls in equity and bonds. So in equities, the underweight is coming down, and even in bonds, we're reducing the duration bet.
Are valuation multiples right now good enough to be able to do that?
Sorry, equity multiples, is that what you said? Yeah, so I mean, we think about two things here, right? One of the things we've been paying attention to is that the actual bottom-up analyst estimates, if you take the S&P as an example, the bottom-up estimates actually been holding up pretty well. In fact, the bottom-up estimates in June, in the midst of all the challenges we saw with inflation, actually moved up. So if you look at outright valuation, on a 5-year basis, almost every asset is super cheap. If you look at it on a 15 or longer term basis, they're between 40 to 60th percentile. So I wouldn't call them as being super cheap. However, whenever we see this big gap occurring between sort of earnings expectations and actual market performance, we generally don't see a significant drop in earnings. So we can anticipate a drop in earnings. So in the S&P, we can anticipate maybe a 5% or drop occurring in earnings, but not a dramatic drop in earnings. So there is some resilience that you can expect from equity markets through these times, because of the fact that investors are a bit more perhaps confident of the path that the Fed is going to take, again with uncertainty, but lesser uncertainty today than there was, say, even a day or two ago.
How attractive are income opportunities for bonds at the moment? The global market is on the cusp of a bear market. You saw a little bit of a recovery on the short end following the Fed, but undoubtedly there'll be more volatility.
Yeah, so there will be more volatility, hopefully lesser volatility, if you know the path that the Fed is going to take. I think it's a tug of war between what I would consider cyclical factors and then structural factors. And if you start looking at valuation, looking at structural factors, which I think as a long-term investor where you should be looking out, so those would be long-term trends on investments in technology, demographic. On those metrics, productivity, on a longer-term basis, bonds are actually looking somewhere like maybe, I would say I wouldn't call them completely in fair value, but in fair value territory. So maybe like, 1 standard deviation around that. If it gets up to about 2 standard deviations, which means that the 10-year in the US starts getting to, say, the territory of about, say, 3.75 or 4, I think that makes it fairly cheap. So cyclically, yes, there could be some challenges, but as you start thinking with a structural case, maybe not that expensive.
Your inflation hedges are cash and commodities. What percentage are you holding in terms of dry powder at the moment for cash? And for commodities, what's your preferred exposure?
So about 10 to 13% over the year we've been holding, compared to, say, in the heydays 2020, 2021, it would have been something like 2%. So significant pickup from that point in time. And really the whole complex. So I would say, we like some precious gold, we like commodities, and real assets to the extent we can get those. So combination of those, and as you think about cash versus other, cash is about, I would say, still about 4%, so maybe a little bit higher than what we've traditionally held, but holding a decent amount in both of those.